Okay. So again, you're welcome. Can you see my screen? You can see my screen. Please give me a 1 in the chat. Let me be sure you can see my screen. Okay, you can see my screen. You can hear me, right? All right, so let's get started. So our class today is understanding risk and money management. Understanding risk and money management. So now this topic is actually the difference between people who are consistently making money and those who are struggling continually and even wondering what is the matter. So in this class today, we are going to understand it. We are going to understand it and we are going to begin to practice this thing. Now, this class is not, there are some theoretical concepts here, but the idea for this class this night is not to give you theoretical concepts. The idea is not to give you theoretical concepts. Some of you might know some of these things already. Some of you might be knowing them for the first time, but it doesn't matter whether you know them before. The most important thing is how are you going to apply it going forward to bank your profits consistently. To bank your profits consistently. That's the idea for this class. Because this is so important. It's the reason why some people will fund account and blow it. Is the reason why some people will have they will wonder what's going on in the market. Why am I not? Why? So there are people that will be trading at the end of the month. They are making money, they make money, they make losses, they make profit, they make losses. At the end of the month, they are break even. The strategy may be good, or the strategy they are trading may be good, or the signal that they are using may be very profitable, yet they are not making money. And when you're not making money, the chances that you will lose money is high. Because remember, for every trade that you take, you're putting up a risk. You're putting on a risk. That's why we have the idea of risk to reward ratio, risk and reward. Because for every reward you're targeting, there is a risk that you are going to bear. There is a risk that you are going to bear. So if eventually you're not making money and you keep putting on risk, the chances that your risk will lead you to a negative account balance is pretty high. The risk that the chance that you lose money is high if you are not making money. So let me give an instance. Now you have, let's say you have a $500 account, right? You put up 1% on that trade, 1%, you want to get into a trade, and you put up 1% on your trade, 1%, in order to make, let's say, 2% or 3%, which means that you are risking 1% of $500 is $5. You are planning to risk $5 in order to make $10 in this case. Now, if you are, for that risk that you're taking, you see that you are risking $5 every time. So if over time, if after some time you're not making any money, the chances that you might lose that $5 and your account goes to $495 is very high. But think about it. If you enter a trade, you risk $5 to make 10 and you make that 10. Okay? You risk another $5 to make 10, you make 10. Now your account balance has gone from 500 to 510. You made another $10, it's gone to 520. And you continue to risk only $5. Only $5. So even if you lose $5 on 520, you still have 515. You see? So now you have a 3% account growth. Then by the time you do that for a while, you will discover that your account will be up 10%, 15%, 20%, even though maybe sometimes you still lose some trades, but it will not matter because you are able to be growing your account profitably. So that's why I said this class is going to be practical class, because the things we are going to learn, we are going to begin to apply it in a very practical way. I'm going to give us, at the end of this class, I'm going to give us an app. I'm going to give us an app that will help you with your money management and risk management calculations. That's why I added my phone so that I can show you guys from the phone. Hold on 1 minute, guys. All right. I needed to let people know that we're live. Okay, so that's what it is. And at the end of this class, I'm going to be showing us, giving us an app, giving us access to a particular app that will help you with all calculations. So stay to the end of the class for all calculations. All you need to do is pop up the app and put some numbers there. Put your account balance. How much you have in your account? Put it there. How much are you risking? Put it there. What's your stop loss? Put it there. It will calculate for you the lot size you are supposed to use. Calculate everything for you. And it's an app on your phone that you can download for free. It's not paid. Okay, so I'm going to give us that at the end of the class. That's why I said I want us to start using the information that we get from this class practically from Monday. It should be practical in your class it should be practical in your trading from Monday. All right, this app I'm talking to you is the app I use before I enter any trade. I go to that app, I use that app. I use that app to take all my trades today. I used it yesterday. I use the app all the time for my trades, right? It tells me what to do. I don't do manual calculations myself. It tells me exactly what lot size to use. What do you need to do? It tells me everything, and I go ahead and I use what it gives me, right? So I'm going to be sharing that at the end. So make sure you stick around. Okay, so let's go on. So money and risk management. What's risk management and money management? Is basically the idea around managing your risk and managing your money properly in the forex market. Okay, now when we come into the market, the first thing we want to do is understand risk, profit, risk and reward. Risk, we deal with risk and we deal with reward. But then our own part that we have control over as traders is the part that has to do with risk. The reward is not controlled by us, it's controlled by the markets. But then we need to have a framework for capturing that reward. You see now, let me repeat that. Now, as traders, what we do is that we have control over the risk that we put on. That's what we have control over. The control we have is over the risk that we put on, but the reward is not in our control. The reward is in the control of the market. But then we also need to have a mechanism for capturing that reward. Because remember, the reason why we're putting up the risk is because of the reward. All right. Now the risk is in our hands. The reward is not in our hands, but we can collect the reward. We have a system for taking that reward and appropriating it to ourselves. You see, so that's the way it works, and we're going to be understanding how exactly we'll do that. Okay, so that's the meaning of risk and money management. You basically want to understand the risk before you enter. So as a trader, we are talking mostly risk. As a trader, when you are entering a trade, you are thinking first in terms of risk. What am I risking? And when we're talking about risk, we're talking about what is your potential loss. Risk is potential loss. Now, I said potential loss doesn't mean it's loss. It means potential loss. Okay? Now, when you are entering a trade, what's the first thing you are thinking? You are thinking of what's going to be my lot size. Okay, so let's move on right now. Let's go to where I can write out certain things. So this is what we are going to cover when it comes to this topic. All right, we're going to be talking about the margin and leverage. How much margin are you using? How much leverage are you using? What's your risk per trade? What's the risk to reward ratio? And all that. Then the last thing I said, I was going to give you the forex calculator. Okay. So now when you are entering a trade, the first thing you are considering, the first thing you want to consider is your risk. You want to deal with, okay, before we go into that, let's talk about margin and leverage quickly. Your margin is the amount of your capital you need to put on a trade. the amount required by you for $8. On the chart, you open a live account, money, and your account has whatever, or maybe it doesn't.
Maryam, dan gani.
Can you hear me, please? Can you hear me?
Yes, I hear you.
Okay, okay. Sorry, guys. I don't know what happened. It just the screen just went off and then the internet just went off. Okay, so we'll continue. It's still recording. Okay, so we're talking about leverage and margin, right? We're talking about leverage and margin. So I said, as a broker, for example, we give you a leverage of 1 to 500. But when you come into the chart and when you open MT4 and you don't have money in your account, when you open MT4 and you don't have money in your account, you can't just place a trade, even though we give you leverage, even though we give you a leverage of 1 to 500, it means that you can't just place trade without having your own funds. And your own funds is what we call the margin. Okay, it's what we call margin. So margin is your own part of the funds that's required to put up a trade. Leverage is what we give you as a broker, right? So now, but understand something. When you have a leverage of 1 to 500, it doesn't mean that you should use all that leverage. It doesn't mean you need to use that leverage. So the truth is that when you are a trader and you want to be profitable, the first thing you want to do is, first of all, ignore leverage. Understand that you have leverage. You have leverage, right? The broker gives you leverage, which means that what leverage means there is that you are able to use more money than you have in your account to put up a trade. That's the meaning of leverage. You have your own money, you bring your own money into the market, it's called margin. That's your own part of the money, is margin. That's the fund you fund. You fund $1,000 into your account, that is margin, right? Now, for you to be able to pick a trade, the broker gives you leverage so that you can take a larger size account, a larger size trade account that your personal account is able to take. For example, trades are in lot sizes, 0.1, 0.1. If you were to trade your account, if you were to trade the exact amount of money that you funded, 0.1 would require $10,000. One standard lot will require $100,000 to trade. But the reason why you can trade one standard lot with $1,000 is because of leverage, right? The reason why you can trade $1,000 standard lots where you only have $1,000 in your account is because of leverage. Okay, so but then you also have to understand that leverage, giving you that leverage is an allowance. That doesn't mean that you should use everything. Because the goal here, guys, for those who just came in, the goal for us in this class is for us to be able to become profitable. If you'll not be making money after this class, take these rules and go and apply them and you will make money. You will start to make money. We are not doing analysis. Yes, analysis is very important. But then there are two people can do the same trading. One, they will use the same analysis. One will be making money consistently, the other one will be losing money. One will be making money and growing his account, the other one will be blowing his account. Every trade he takes will blow his account. Another person, when he takes trade, he grows his account. The difference between those two people I just described now is what we are teaching today. This is what's happening in this class, on this class tonight. Right? So very important that you understand that yes, you have leverage, but then you are not going to use the leverage the way they give it to you, the way the brokers give it to you, right? You are only going to use a small fraction of the leverage that you are given. Your goal is to protect your money. In traditional finance, when you are very highly leveraged, it's a huge risk. Your leverage makes your account unstable. Your leverage, the larger the leverage you use, the more unstable your account will become. The more you're unstable, your financial situation will become. That's the way it is in traditional finance. When you are heavily leveraged, you are in bad shape. That's what it is. When you are heavily leveraged, you are in bad shape. So you don't want to be too heavily leveraged, But you can't do much without leverage. You are going to need leverage, but you're not going to use much, right? Good. So let's move on to the next thing. The next thing is we're talking about now is risk per trade. So like I said before, for those that just came in, when at the end of this class, stick around, there's an app I'm going to give you that will help you with calculations, your forex calculations. When you want to enter a trade, right? When you want to enter a trade, when you look at your capital, how much am I entering this trade with? That's the first thing. You know that one is the money in your account, right? The next thing you want to consider is what is my risk per trade? What am I risking on this trade? Now, listen to me, guys. I have been in this market for a while, so I can I understand that there are times where we do trainings or people attend classes and they really take what is being taught on a theoretical basis. Okay, what we are teaching today is theoretical, but it is I want you to understand it differently. But this is very practical, even though it has theoretical concepts, but it's very, very practical. And the goal is for you to be able to use this information after today, use it properly. Let it no more be theory to you. Let it become practical to you, okay? And honestly, that is the truth. This is the turnaround. Understanding this thing and being able to use it properly is the turnaround for most traders, apart from issues of psychology, which we are going to discuss in another class. Apart from issues of psychology, this is something that you're going to deal with. And I can tell you something. This, when you understand risk and money management properly and you use it, you apply it properly, it will take care of your psychology issues to a very large extent. It will take care of your psychology issues to a very large extent. How many of you, I'm sure many of you you're thinking about trading before, is that when you place a trade, you have to be watching it every minute, every second, right? Every minute, every second, you need to be watching. Let it not go negative, let it go positive. You are watching, you are like monitoring spirit, you are monitoring your trades. That's the thinking many people come into trading with. They think that when you place a trade or you want to enter a trade, you need to be watching it like hawk. But the truth is that if you are watching your trade like that, something is wrong. That's the fact. Okay, I'm not just a trainer, I'm a trader. I can tell you that, right? If you put on a trade and you have to watch it so that something doesn't go bad, you don't lose money or you don't lose big money, something is wrong. Your calculations are wrong. You have done something wrong on that trade. And the truth is this: you may be able to save yourself from that trade, from making a loss, or even you may even make a big profit. But the day your account will blow, it's coming. That's just it. That's why some people think that you always need to blow accounts. I remember a guy when I was getting introduced to trading many years ago, the guy had this concept that you always blow accounts will always be blown. That's what he thinks. And he always blew accounts. And he was in trouble at the time I was talking with him. He was in trouble because he had taken lots of money from people and he blew the money and he lost. So he had this mindset that accounts will always be blown. And those are the same people who believe accounts will always be blown are the same people that believe that you fund $100 and grow it to $400 in one day. It's the same people, the same group of people who believe that, oh, I can take $400 and I will grow it to $400 in one day. It's the same people who think, oh, that account can also blow. You see, you don't want to be in that category. You want consistency in your progress. Consistency, because you can grow $10 to 10,000 if you do the right thing and do it the right way. Okay, so this is why this class is very important. So now, the first thing you want to consider when you see a trade, you get, let's say, a trading signal, whatever, you get a trade, the first thing you are considering, the first thing to consider is number one, what is my risk per trade? What is my risk for this trade? What is my risk for this trade? What is going to be my risk for this trade? That's the number one thing you are considering. What is my risk what is the risk I'm taking on this trade? You see, what is the risk I'm taking on this trade? That is the most important thing. What is the risk that I'm taking on this trade? Okay, that's the number one thing you're considering. That's the number one thing you're thinking about, right? Number two, and that's risk per trade. It depends on you. It depends on the account that you are trading, right? Your risk per trade should be between 1 to 3% of your account. Your risk per trade should be between 1 to 3% of your account. That's what it should be. And this is what you consider before you enter the trade. You know this before you enter a trade. Even 3% is high. 3% is high. 1 to 2% is good enough. But let's just put it there, 1 to 3%. Okay, that's the first thing. So what that means is that if you have $1,000 in your account, $1,000 in your account, your risk per trade means that you're going to have let's say we use 2%. 2% of $1,000, 2% of $1,000 is $20. $20. So $20 is what you are putting up as risk for that trade. $20 is what you are putting up as risk for this particular trade, for your $1,000. Remember, this is just one trade. This is not 2, 3, 4, 5 trades. You can decide to use 2% for 5 different trades. You may put 2% here, 2% there, 2% there, Euro USD, gold, GBP USD, JPY, like that. Let's say you're taking 4 or 5 trades and you put 2% on each one of them. That's what you are doing. So every trade you're taking, you put in 2%. Every trade you're taking, you put in 2%. For every trade you put in 2%. Now, like I said, the app I'm going to give you will do this calculation for you. All right? All you need to do is give them some few parameters and they'll do all the calculations for you. Right? I'll show you that, guys, at the end of this class. That's number one. Number one is risk per trade. What is the risk per trade? Okay? This is still number one, sorry. This is not number two, this is number one. So risk per trade is typically 1 to 3% on your account, and you define that before you start. You define that before you start. Number two is, what is my stop loss? Remember what I said before we started this class. I said, as traders, we deal with risk and reward. Okay? Now, in every endeavor, in every business, in every whatever it is you're doing, the only reason you embark on a project, the only reason you take a risk is because there's a potential reward. The only reason you take a risk is because there is a potential reward. But in trading, watch this, guys. But in trading, the part that you control, the part that we control as traders is the risk part. The part that we control as traders is the risk part, not the reward part. The reward part is up to the market. But we must have a mechanism in place to capture that reward. I'll just say that again. Those who were here earlier, they heard me. But as traders, what we control is the risk. The reward is up to the market. But we need to have a mechanism to capture the reward, even though it's up to the market. What do I mean by that? If you enter a trade, how do you know the trade is going to go to 100 pips? There's no way of knowing. How do you know that this trade is going to reach 50 pips? Let's say your target for the trade is, you set a take profit of, you're targeting 50 pips on the trade. How are you sure that the trade is going to go into 50 pips? There is no way of knowing. But watch this. There is no way. That trade may go to 50 pips. It may go to 30 pips and reverse. It may go to 60 pips. It may go to 200. That is a part of it that you cannot tell. It's like the future. You cannot tell it like that, except you're a prophet. And prophecy is a gift from God. Okay? So now, yes, there is no way of telling the future. What is going to reward? How much profit am I going to make from this trade is basically the future. Yes, but in the market, you can make projections because we can look into the market, look at what has happened in the past, historical data in the market. Every candlestick you see in the market is data. So it can always tell us support, resistance, support, resistance, all of those things. They tell us They can give us an idea of where price is going to go, right? We can project, okay, based on what I'm seeing, like all the charts we've been seeing in the group. Oh, based on what I'm seeing, I think that price is going to go to this point. Price is going to do this. But yes, you are going to project that, but you cannot guarantee. The discussion I was having with someone today in the guard, I said, well, the truth is that the calculation, the analysis was done in such a way that price will pull back to a certain area, but price did not pull back to that point. That's why the trade did not trigger. That is something that is not within the control of anybody, right? So, but see, if a trade goes against you, that's the one I just described earlier now is the reward. But if a trade goes against you and you risk $20 on a trade, you know that for sure that trade is, you are going to lose $20. That one is for sure. You see, you are going to lose $20 on that trade if that trade goes against you. That's for sure. You know that for a fact. But when it comes to the reward part, you don't know how much reward you are going to get. You don't know how much reward that you're going to get. So that's why you want to control the risk and then set a parameter, set a framework for capturing reward. Okay? So now the next thing you're going to do is, what is my loss? What is my stop loss? What is my stop loss? What is my stop loss? Do not ever enter a trade if you don't know what your stop loss is. Don't enter the trade. Number one, if you don't know what your risk per trade is, don't enter a trade. If you don't know what your stop loss is on a trade, whether you're doing an analysis by yourself or you see an analysis in the group, you must see all the analysis you see me post there. I always show you what you always see on the chart: stop loss, take profit. You always see it there. And even all the analysis we always post early in the morning and the rest of them, you will always see stop loss. You will see entry price, maybe it's a pending order. You will see stop loss. You will see take profit. There is a reason why they are there. There's a reason why they are there, because they are extremely important, right? So you must know, what is my stop loss before you enter any trade. What is my stop loss? Some of us have heard these things so many times. We think that they are not important. They are just theoretical things that people always say in trading. And if you think like that, I will challenge you to look at your account right now. Show me how much you're making. How much have you made? That's the proof that you are not, that this thing that you hear in trading, they are not theoretical. They are actually practical things that you should make practical. So if you enter a trade and you never think about how much I'm risking per trade, you never think about stop loss, I can guarantee you are losing money right now. You may make money sometimes, but you will lose money. You will eventually lose the account because you're not thinking of the most important things in the market. You are only chasing profit, and profit is not guaranteed. Profit is not guaranteed, right? So you want to take care of the downside so that the upside takes care of itself. You want to take care of the downside so that the upside will take care of itself. That's how it is. There are trades where you enter the trade. I'm sure if you've been trading for a while, you understand, you will relate to this thing I'm about to say now. You enter a trade, and the trade, you decide that, okay, this trade is going to go to a sell, right? And you place a sell, and you use a big loss size for a small amount of money in your account. And then the trade goes against you and blows your account. The trade blows your account, and then it now moves in the direction you already knew it was going to. Do you see that? You know that this thing is going to sell, but before it started selling, it was buying first. And then you enter the trade with big loss size on top of your little money, and then it blew your account before it now moved in your favor and now did 100 pips, 200 pips. And you're like, God, look how the money I missed. Why is that so? That is so because you are chasing profits. You are not taking care of the downside. Take care of, as a trader, take care of the downside, let the upside take care of itself. After this class, guys, let us go practical. Let us go practical. Let us put these things to practice. I'm telling you, you can be a pro trader just by putting these things to practice for a month. You become a pro trader. You become someone who can mentor other people just because you are putting these things to practice. That's just it. Yes, there's a part of analysis. Analysis, you don't learn it overnight. I understand that. But there are lots of people who know how to analyze and they're still losing money. Okay. And the reason why they are losing money is the topic of this discussion tonight. Right? So what is my stop loss? You want to make sure that's in place, right? So what is your stop loss? Number 3, what is my risk to reward ratio? What is my risk to reward ratio? What is my risk to reward ratio? So what does this mean? Okay, some of you might have heard of this before, but what does risk to reward ratio mean? Fine. What am I risking on my trade, on the trade I'm taking? We said before, number 1 thing you're going to think about is what is my risk per trade? Yeah. What is my risk per trade? That's what you're thinking. That's the number 1 thing you're thinking. Now, the number 3 thing you're thinking is, what is my reward for this trade? What is my reward for this trade? What am I going to gain from taking this trade? Am I going to come into a trade and take 5 pips? Is that what I want to get out of this trade? Now, what is 5 pips? Am I entering a trade with $20 risk only to take $10 as profits? You get my entry? How should that? He was not. He said the risk reward ratio he goes for is like 1 to 10, 1 to 15. That he has worked hard for his money for too much. As in he worked so hard for his money that he cannot put it on a small trade. So his trade is he's going to enter a trade that's going to be running for weeks. Of course, that's his personality. He does the way he trades. But what I'm trying to say from that is that he's looking at what is my risk to reward. Am I entering trade with $20? In this case now, we are entering the risk per trade is $20. Are we going to enter a trade with $20 risk only to target $10 profits? How do you do that? You can't do that. You're not going to enter such a trade. No, that's not a good trade. A good trade is a trade that gives you an equivalent amount of reward or more. Your risk to reward ratio has to be a minimum of 1 to 1. 1 to 1, okay? Somebody in the group was saying the other day how he has 1 to 19 risk to reward ratio. If you can get that kind of risk to reward ratio, amazing, fantastic. 1 to 2, 1 to 1, okay, that's 1 to 1, 1 to 2, okay, 1 to 3, 1 to 5, etc., etc., etc. That's what you're looking for. What I'm trying to say is that for every trade you are taking, you are risking money, right? You are risking $20. In this case now, you are risking 2% on your account on a trade. What am I going to get from this trade? What is the minimum you should go for on that trade? It's another $20 profit. Remember, if your risk is not taken out, your reward will be taken out. If that trade goes against you, you will lose $20 guaranteed. But if that trade doesn't go against you, you want to be able to make good money. At least make as much money as you risked on that trade. At least make as much money as you would have risked on that trade. So that becomes a sustainable thing. If your trading is if your strategy is very good, very, very good, you can work with 1 to 1 risk to reward ratio, which means that for every $20 you stake on a trade, your risk per trade is $20, your reward is also $20. But if you can make your reward $30, if you make your reward 1 to 2, which is in the case you are risking $20, you are making $40. That's good. Now, if you can risk 1 to 3, if you can risk $20 to make $60, amazing, right? If you can risk this 1 to 5, if you can risk $20 to make $100, that is good. So this is what we are talking about, the reward. The reward is taken care of by the market. The market can move very heavily. Since yesterday that I've been showing, USD/JPY has done over 300 pips since CPI news yesterday, over 300 pips. You understand? So imagine that your risk on that trade was 50 pips. Your risk, and once that risk has gone away, because once your trade is in profit, that risk is gone. You are no more at risk Now, you take your trade, you put it in break even. You put your stop loss in profits. Now, when you are entering a trade, your stop loss is in negative, right? At the entry of the trade, at the beginning of the trade. When that trade goes in your favor, you put your stop loss in positive. That's what we call trade management. Probably we'll talk about that in another class. That's what we call trade management. You put your stop loss in positive. When you put your stop loss in positive, it means that that trade has no risk anymore. You have your risk, the initial risk that you put on that trade, which was 2%, has gone to 0. Now you have no risk on that trade anymore. In that case, you go for the reward. Now you are only chasing reward because the trade has triggered, the trade has gone in your favor, you have moved your stop loss to positive. Now you are only going for reward. So now you are thinking, how much can I make from this trade? Should I make the equivalent of my risk, or should I make like 2 or 3 or 4 or 5 times my risk on this trade? That's what you're looking for. So the more you are able to make, the better. But what I'm telling you is that if you're an intraday trader and you're looking for quick profit, you come into the market, you trade quickly, 1-to-1 should be the minimum you are going for. 1-to-1. The minimum you are going for on your trade is 1-to-1. That's the minimum. Okay, so we have 1-to-1, we have 1-to-2, we have 1-to-3, we have 1-to-5, we have 1-to-10, we have 1-to-15, we have 1-to-20. It depends on how much you can. It depends on what's your time frame for trading. If you are someone that trades, that does swing trading, and you can put up a trade and the trade running for days or weeks, of course you can go for larger risk to reward ratio. Larger, even 1-to-15, 1-to-20, you can do that. 1-to-30, yeah. But if you are an intraday trader, you trade within the day, you take signals and all that, you want to be able to get at least 1-to-1 or 1-to-2 from your trade. So if you risk $20, you want to be able to make at least $20 or $40 on that trade. So that in the case, if you make a losing trade, one losing trade, it doesn't matter because you are still going to make, if you make one losing trade, you only lose $20. On the next trade, you're still going to make another 40 or $60 because you are using 1-to-2, 1-to-3 risk to reward ratio. These are things you consider before you enter a trade. Otherwise, these are the things that actually determine whether you enter the trade or not. Not chasing, not the way most of us have always done it. These are the things you consider before you enter a trade, right? Now, when it comes to this risk, we talked about your risk per trade. Then something else you're going to consider with your stop loss is, what is my lot size? Lot size. What is, okay, now that I have seen now that I know how much I'm risking 2%, which is $20 in this instance. Now I know what my stop loss is because I've calculated my stop loss, or maybe the signal I'm taking has given me stop loss. So what's going to be my lot size? You see, what's going to be my lot size? Your lot size, guys, is the way you condition the chart to tell the chart that you are risking only 2%. Oh, this trade I'm taking, I want to risk 2% on this trade, right? I want to risk 2% on this trade, which is $20. The way you condition the charts, the way you tell the market that I'm going to only risk 20%, $20 on this trade, which is 2%, is by your stop loss and your lot size. Your stop loss and your lot size is how put together, is how you calculate, is how you define to the market the risk you are actually putting in the market. And this, I'm going to give you a calculation now, but this calculation, you don't have to do it manually. That's why I said I'm going to give you an app that will help you do this calculation. This calculation, I do it every time I enter a trade, but I don't do it manually. I do it through the use of this app I'm going to show you guys. And I'll show you how to get that app for yourself now, today, after this class. All right, so let's do a quick calculation here. So now, we've determined that our risk per trade is $20, right? Okay, now we determine, let's say in this case now, we have risk per trade. Risk per trade is $20, good? $20, fine. Now, so what's my stop loss? Stop loss is what? Let's say stop loss is 50 pips, okay? Now, 50 pips is the same thing as 500 points. 500 points. So whenever you see points, you see pips is the same, but the relationship between them is that 50 pips, 10 pips is equals 100 points. 1 pip is equals 10 points. 1 pip is equal 10 points. 50 pips is equal 500 points. 10 pips is equals 100 points. So the relationship between pips and points is that with pips, you just add, with points, you just add a 0. You multiply pips by 10 and you get points. And now the reason why using points is important is because it helps you with calculations. You see these numbers you have here, these numbers on your chart, they're actually done in points, not in pips. They are done in points. So when you are doing calculations with these numbers, you are actually going to be in a good shape when you do it with points rather than with pips. But pips is what we've always been taught before, right? So that's why a lot of people relate in terms of pips. But just know that 500 points is equal to 50 pips. It's the same thing. 500 points is equal to 50 pips. 10 points is 10 pips is equal to 100 points, right? Good. So stop loss is 50 pips, which is equal to 5 points. Right? So what is lot size? Can you hear me now? Can you hear me?
We can hear you. Yeah, we can hear you now.
Okay, all right. Sorry for the break in the network. Okay, so the lot size here, like I was saying, the lot size here is risk over stop loss. So risk is $20. Risk is $20 over stop loss, which is 500 points. Okay, so if we do that calculation, what do we have? Let's do that quickly. 20 divided by 500. 20 divided by 500. That means that we are going to be using 0.0 lot size for our trade. Lot size for our trade. All right. Now, this thing I'm telling you, you don't need to calculate it yourself. We're going to go to that place right now. So let's go. I'm going to make host my phone. Let me go to my phone and make it host so that we can go ahead and do that. I'm going to show you guys right now how that is done. Okay. So let me go to my phone now. And then I'll share my screen and show you guys how to do this. Screen, okay, screen. Okay, good. We're on my phone right now. Okay, so what you do is that when you're starting on this, you go to Play Store. You go to Play Store if you're on Android. You go to Play Store if you're on Android, and then if you're on Apple, you do the same thing. You look for Forex Calculator. Forex Calculator. See, there is also Forex Calculator. Forex Calculator. Okay. So now on my phone, now you're seeing it showing me. You're seeing it showing me open. It's saying open. The reason it's showing me open is because I already have it on my phone. I already have it on my phone. That's why it's showing me. If you just start, it's going to be showing you download. It's going to be showing you to download it, right? When it shows you download, just download it. You can see the logo, see everything, right? Forex calculators. So now when you have downloaded it, you can then now come to your phone. Okay. You can then come to your phone now, and then you look for it. Let's look for it. Forex calculator. So this is it up here to the top right-hand side of my screen. Forex calculators, right? So we click on Forex calculators. All right. So now let me close it and open it again. Okay. Always make sure you do that. If you're clicking on it and it's not opening, just if you left it for a while, you used it, you left it for a while, and you come back and you click on it, it's like it's not clicking. Just close it, cancel it, and then open again. All right. So I notice that it does that sometimes. So now here is what you're going to do. You can see now the app has many things. When you go to the hamburger sign, which is the top left-hand side of your screen, you go there, you see position size, stop loss, and take profit. You see all the things that this app can do for you. Can you see this? All the things, margin, peak value, Fibonacci, pivot point. So many things it can do for you. So many things. So if you have downloaded it, play around with it and see what this app can do for you. It can show you a lot of things, right? It can help you get your trading, make your trading better. All right. So now we'll click on position size. Position size is what we want to deal with on this right now in this class. Position size, right? So make sure leave this one on USD, right? Because most of our trading is done in USD, and also our broker is USD. Of course, you can use there are the option of using other currencies, but USD is most popular. So we'll stay with USD, right? So on that currency pair, go to currency pair, look for the currency pair you want to trade. As you can see, all of them are here. There's BTC, there's US30, there's NAS 100, there's EOS is the cryptocurrency, there is Ripple, there is Ethereum, there is, there are many. there is Euro USD, there is GBP USD. Let's say we take GBP USD, for example, right? So let's say our account, from what we discussed then, our account is $1,000, right? And then we are trying to set that trade we're calculating just now, right? So what we do now is that we set it, our account is $1,000. Whatever is your account balance, put it here, $1,000 under account balance. Then what is your stop loss in pips? Watch this. This is in pips. This is not in points. So our stop loss for that trade we're discussing was 50 pips. 50 pips. Okay, so we come here, we cancel that, and we put 50 pips. That's 50 pips, right? So how much are we risking on that trade? We said we are risking 2%, right? We said we are risking 2%. 2% what we are risking. So click here, you cancel it, and you put 2 there. Can you see this now? So what are we looking for? We are trying to get our lot size that we're going to use for this particular trade. This is not something you do once in a while, once and for all. No, you do it for every trade you want to enter. Every trade you want to enter, this is very important. You do it for every trade you want to enter. So you take put your account balance there, you put your stop loss in pips, okay? Whatever the amount, if you calculate it in points, just remove 0. Remember what I said about pips and points. Then what's my risk per trade? You put 2%. If you want to make it 1%, fine. If you want to make it 0.5%, fine. If you want to make it 3%, fine. Just put it there. Whatever you choose, put it there. Then click on calculate. So can you see it now? It shows you the amount of risk is $20. You see that calculation we did that time is giving us here now automatically. $20. Now it's telling you what is my lot size, where it says standard lot 0.04. Was it 0.04 we calculated there? So can you see how this guy calculated it for you now like that without you having to do any calculation? You don't even know the formula behind it, yet it is done for you. I do this every time I need to take a trade. And I recommend that you do this for every trade you want to take. This is how you determine the lot size you are going to put. So don't trade blindly. Don't trade blindly, because every trade has its own stop loss points. One may have a stop loss of 30 pips. The other one may have a stop loss of 50 pips. The other one may have a stop loss of 70 pips. All of them should be calculated differently for you to get the lot size for each particular trade. Just the way you are setting your stop loss, you are setting your take profit, you are setting your stop loss, you're taking your take profit through your risk to reward ratio. If you are setting stop loss of 50 pips on that trade, that means your stop loss should be at least, your take profit should be 50 pips or more. That's what risk reward teaches us, right? So this is what you are talking about now. Now, right now, network is too bad. Well, sorry about that. Indeed, really, it's quite bad. So right now, you can see all this here. Now, your lot size, you just pick your lot size, and you are able to use that lot size and place your trade, right? So this is what you have to do, and then this is what you have to do, and then you'll be able to go ahead and do your trades and be okay. Okay. That is what it is. So we are going to go on now and finish up the class. Stop the recording. Okay, share screen. Who's disabled participant sharing screen? Oh no. Hold on. 10 minutes. Let me cancel this. Let me even exit.